Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, part of our business development team here at iCM, and today I'm joined by iCM's Chief Investment Officer, Mike Paciotti. Mike, thanks for jumping in.
Oh, glad to do it.
All right, so let's get to it. And in this quarter's Market Insights letter, What Matters More to Investment Results, Market Cap or Style, you talk about the concentration of returns with the Mag 7 doing the heavy lifting, really for the broad S&P 500. And in historical context, I can't imagine that this is really healthy for the market as a whole. How has this played out for investors in other eras?
Well, so you're correct. It typically isn't a healthy sign. So you could go back as far as the 1930s. The 1930s were a period of concentration. Then you had 1973, 2000, 2009, 2020, and now. So there's actually this really obscure methodology called the Hefferndahl-Hirschman Index, or approach rather, that measures the concentration. It's actually useful to get some historical perspective on the degree of concentration. So its actual intended purpose was actually for antitrust purposes. Regulators used it when evaluating M&A activity, but it's useful for this purpose too. So based on this approach, the most concentrated era in history was back in the 1970s with the Nifty 50, and then of course again today. So both actually surpassed the level of concentration seen in the internet bubble by actually a fairly wide margin.
All right, Mike, can you talk a little bit about the internals? I've heard you mention some things there from time to time.
Well, so the other thing that we like to look at is the allocation or the weight in the index compared to the earnings contribution of those same names. So, what weight is the market giving you as a company versus what economic value are you contributing? Over time, they actually need to match. So today, the top 10 holdings of the S&P 500 comprise upper 30% of the index, while contributing only about 28-ish% of the earnings. So another interesting fact along those lines, anytime the index concentration has really surpassed the mid-20s, the bottom 490 names have actually outperformed nearly 90% of the time over the next 5 years.
Wow. So you also talk about the question of cap versus style. Can you talk a little bit about your findings generally?
Yeah, I mean, the article was actually born out of our own research, our own intellectual curiosity a few years ago. So we basically did this for our own internal research purposes, in that we wanted this answer, given that everyone seemed to be so style focused. So it seems particularly timely now to publish this, given that the concentrations that we kind of just discussed. I mean, this is an important time to actually to really know this, especially if leadership stands to change. So what we were trying to answer is not which has been better. That's been addressed, and it's honestly time period dependent. Our question is more specifically, is it more important to be consistently in the correct market cap or consistently in the correct style, and which is survivable if you get it wrong?
All right, so the big question, what did you find?
Well, what we found was being consistently in the correct market cap was more important than being in the correct style, actually by a pretty large margin, by a 2-to-1 margin. So similarly, as you'd probably expect, it's better to be in the correct market cap and in the wrong style rather than being in the correct style and the wrong market cap. The performance differential here was actually even larger. It was a 4-to-1 margin. So the moral is, if you're active, you really want to get your market cap decision correct above and beyond anything else in the cap versus style debate. And while the media has been really consumed with the whole growth value dynamic, especially as it relates to technology and the Mag 7, it really is kind of a secondary factor. And today this is kind of important because at an aggregate level, investors have made a huge bet on U.S. large cap stocks. 92% to 8% is the allocation.
All right, Mike, can you explain that a little further?
Well, sure. Yeah. So if you look at the total value of U.S. mutual funds and ETFs, you can determine what investors own in aggregate, what their allocation is collectively, and it's 92% US large cap stocks today.
All right. So the advice that you give in the letter is to essentially examine the overall landscape and be aware of segments of the market that have become overvalued. All right. So since those areas are probably the most over allocated overall, what would you suggest as a reasonable step for investors really faced with the dilemma of where do we go from here?
Well, what you said is true, right? So yes, typically investors end up over allocated to bubble assets, right? I mean, it's hard to form a bubble without some either fevered buying or long-term flow into the segment. And investors have been historically bad at timing these types of things. They're usually too late getting in and too late getting out. So one could debate a lot of things in investing. It's hard to argue with diversification, even though I've heard a bit of that recently with some calling underperformers quote unquote dead assets, right? So the whole point of diversification is that you have some things doing well while something else isn't. If everything is doing well at the same time, you're probably not as diversified as you think you are. Now, small cap is an asset that's been out of favor for quite some time, both from a valuation standpoint and statistically, as I quoted before, with the other 490 names outperforming 90% of the time when the index becomes concentrated, it's probably not a good idea to be so lightly represented there in this environment.
Sure. So, with everything we've talked about today, how is this reflected in our positioning at ICM?
Sure. So we've been underweight, as you know, for quite some time, which made sense due to the valuation environment that we were in, and it's worked exceptionally well. But with the massive degree of underperformance of small versus large, meaning large outperformed, we the valuation story has really started to change there. So at this point, it makes sense to start thinking about that mix and start leaning more heavily towards small than really we have in the recent past. So we don't really believe that this is kind of the push your chips in moment, but small certainly deserves a larger allocation than most are giving it.
Mike, great information, and I appreciate you being here.
Oh, great to do it.
And thanks to our audience and viewers. Should you have any questions on this or any other topic related to ICM's portfolios, please reach out to us at 888-426-4689 or via email at info@icm-invest.com. Thanks for watching.